Hi, this is champion trader Kevin Davey, and today I'm going to share 4 unique algo trading entries that you can use in your own trading. And what makes them unique is that they have a little twist to them. So stay tuned. Well, thanks for joining me today. So today I'm going to talk to you about 4 algo entries that are unique, not because of the entry themselves, but because how I use them in the strategy. And you can apply this to just about any trading strategy or any entry you have right now, and you can pretty much quadruple the number of things you test. So it's pretty cool. To help me out, I used software. It's called Multi-Op, that was created by a Strategy Factory student of mine, and it's a rapid prototyping tool to help you build strategies a little quicker, yet still avoid things like curve fitting and overfitting. So that's what I'm going to be using today. Okay, so let's look at entry number 1. It's just a simple double momentum where there's a long-term trend, let's say it's down, and then there's a pullback that goes up, and then you enter short. And of course, it's vice versa for longs. This is just a standard pullback approach, so there's nothing really unique about this. But let's add a twist to it. Let's calculate that on a second data stream that's different than the first. So, for example, let's say I want to trade crude oil. Well, I'm going to get the signals from the mini S&P. So that's going to be the double momentum of the mini S&P applied to crude oil. That's what makes this so unique. Not a lot of people are doing this. It's not a new idea. You can get John Murphy's book and learn a lot about intermarket analysis, but very few people do it. I would estimate less than 10% of algo traders do things like this. And there's a lot of benefit in being unique. You don't want to be trading the same way everyone else is trading, right? Well, this is a way to avoid it. So here's some sample code, and that's in TradeStation format. And again, there's nothing special here. It's the fact I'm using it with data 2 to generate the signals. And here's a sample equity curve. This isn't an optimum result. This isn't necessarily a tradable strategy. It just gives you an idea what this can do. So that's unique entry number 1. Let's take a look at unique entry number 2. Now, unique entry number 2 is a double momentum, but what I added here was a small RSI filter. So for long trades, if the RSI is above 50, that's a filter to go long. And if it's below 50, you go short. But otherwise, it's just a standard double momentum, just like the last one. So it's basically the same strategy, just with a little twist to it. And by itself, it's not that revolutionary. But how I apply it kind of is. And what I'm doing here is I'm executing on 360-minute Euro currency bars, but the signals come from daily Euro bars. And that's what makes this unique. And the RSI is actually calculated on the 360. So I'm actually calculating the signal off of 2 separate data streams and applying it to the Euro 360. And again, what is great about this is not many people are doing it. I would estimate 5–10% of people create strategies like this. Most people create strategies that are single market, single time frame, and they don't mess around with some of these more esoteric type things that we're doing here. So there's a lot of value in doing that, and remember that. So here's the sample code. Here's a sample equity curve, and again, it's not the optimum result, but it gives you an idea of what you can do with that. And then, as a bonus, you can combine entries 1 and 2 And very, very few people do that. So you could do something like trading 60-minute oil bars, but base it off of signals from 360-minute gold bars. So different time frames and different markets. Now you're really getting unique compared to most people. Entry number 3 is a double momentum with an ADX filter. So an ADX calculation, if it's above 20, it'll tell you you're in trending mode, and that's the only time it's going to take new trades. So again, it's not that much different than the double momentum, but what really makes this unique is I'm going to run it on a weird time frame. In this case, I'm going to take a 128-minute bar, which I guarantee you not a lot of people are doing it. A lot of software is set up with standards of 60-minute, 120-minute, and those kind of time frames, 1 hour, 2 hour, 4 hour. And that's just what people use because it makes sense. Well, what about something odd like 128 minutes or 252 minutes or, something different? What ends up happening is you get much different patterns and you get much different indicator values because now your bars are all different. And again, that helps you be unique. So you can use any minute size bar you want as long as it's something non-standard, and that's where the value is this. And again, for the third time, very, very few people do this. I would estimate under 5%, maybe a couple percent. Most people just use standard 1 hour, 2 hour, 4 hours. And that's where the uniqueness is. And again, standing apart from the crowd is what you want to do. So here's your sample code. Here's some sample equity curve. And again, it looks good. It would have to be refined, but you get the idea that something like this could work. And that's what's important. Entry number 4 is a double momentum with a long-term moving average. So I'll take long-term trades. Price has to be above the 50-bar moving average. And as long as that happens along with the double momentum, then this works out just fine. Now the twist is something you can see by looking at these two charts. They're both lean hogs and they're both 120 minutes and they're both the same time frame. Yet the two charts look different. Why is that? Well, that's unique twist number 4. And it has to do with how the bars are built. TradeStation by default uses session hours. So if my session started at 9:30 and I used a 60-minute bar, the first bar would run 9:30 to 10:30, then 10:30 to 11:30. But there's also an option for natural hours. And in that case, the first bar would only run from 9:30 to 10 o'clock, and then it would be 10 to 11, 11 to 12. It would work on every beginning of every hour. And that's what makes it different. It's completely different results, different indicator values, different patterns. And in 16 years of TradeStation, I've only seen 2 people ever use this. And both of them used it by accident. They didn't even realize they were using it. So this is very unique. And like I said, there's value in being unique. So here's the sample code. Again, nothing special. Here's an equity curve with a strategy with natural hours. And just for comparison, I ran it in session hours. And you can see, in this particular case, the natural hours blows away the session hour results. So this is a pretty cool thing to do. So just to sum up, try these approaches with some of your existing strategies and ideas. You'll get a lot more things to test. The key is you got to have a good development process, of course. These entries all work and they're simple. And maybe they work because we're using them in unique ways. So that's why you got to try them. See if this works for you. And just remember, there is value in being different than the crowd. And that's what this is all about. You want to be different than the crowd. So, if you like this video, please subscribe to it. Leave me a thumbs up. Leave me a comment. Which of these do you like? Thanks for watching. I'm Kevin Davey. Have a great day.